Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have James Beasley, Senior Director with Nasdaq Governance Solutions, with Corporate Governance Outlook in Europe, Middle East, and South Africa for 2022. James, it's great to have you with us. Welcome to Trade Talks.
Thanks, Jill.
Looking ahead to 2022, are there any corporate governance themes you expect to be in focus in the EMEA region?
Oh, gosh, there may be too many to choose from, actually. Well, I think it's good to be able to say that good governance continues to increase in prominence in the minds of directors, shareholders, governments, and societies at large across the region. So I'm looking forward to exciting new developments in 2022 as part of our onward journey in the region. Overall, I expect we'll see considerable focus on embedding diversity and inclusion, ESG, and workforce engagement into organizations' visions, their values, their strategies, cultures, and risk oversight responsibilities. So bringing those hot topics into every aspect of the board's role. So for example, measuring and challenging strategy implementation with explicit consideration of the impact on employees or particular initiatives, or for example, defining company culture framed through diversity and inclusion goals. I think overall organizations can do so much more at the board level and beyond to demonstrate and to cohesively articulate how they embed enlightened expectations. One other area I think, I expect to see gaining real traction is risk governance. So a long-time challenge, I nearly said headache there, for financial services firms in particular, where regulators have increasingly focused their attention. The greater prominence of ESG as a concept in the collective psyche, and the COVID pandemic especially, have brought a greater focus on how risk is overseen. So particularly when we are talking about the less tangible risks, such as those related to climate change or social upheaval. So firms of all shapes and sizes now need to have risk in the spotlight. So in recent years, stakeholders and from the largest shareholder to each and every employee have seen the consequences of improper planning, identification, testing, measuring and monitoring of risk. And firms are continuing to have to test themselves on how clear roles and responsibilities are, who manages risk, who owns policies and procedures, how they know they're working, and where the buck stops.
Have you observed any shifts in boardrooms in the region over the past year?
Yeah, I think, of course, over the last 18 months, that has had a big impact on the way boards operate, how they interact with management, employees, wider stakeholder groups. I think we'll see many of the lessons learned incorporated into practices going forward, even as we return to normal. So directors suddenly found themselves, of course, through the pandemic, not being able to meet with each other in person, to hold formal meetings in person, to hold strategy days, employee days in person. And they haven't been able to walk the floor with staff or visit company locations. So many of the boards that we work with are still grappling with what the new normal should be. But that's because there have been some quite interesting developments, I think, through the pandemic that might really add value. So the practice of holding virtual meetings seems to have held up really well, aided by modern technology for video conferencing, digital board portals enabling sharing of information, recording approvals. Most chairs and directors I speak with want those to continue in some form, for ease and with environmental considerations at heart, saving on travel. So the focus for many now is identifying which meetings are required to be in person, I think. But really interesting is the stakeholder engagement piece, I think. So new behaviors at board level have come through the pandemic. The tremendous impact of COVID on employees and customers, especially it drove a focus on how boards understand the impact and connect with stakeholders during the upheaval. So they reviewed information in a new way or looked at new management information. They requested specific agenda items, the questions they asked, and the other tools such as setting up new governance fora were used to connect with and understand stakeholder impact and stakeholders in general much, much more closely.
Is there an EMEA region that is leading the way in the corporate governance landscape today?
I think that's a really interesting question. I'm going to evade it ever so slightly. I think it's important to recognize that different regions and countries have different histories, traditions, legal and regulatory constructs, and cultures in regards to governance. So varying practices and level of maturity that we see across EMEA. And when I say maturity, I mean maturity of governance frameworks. They're in part driven by the events, the different events in countries. So, the massive impact of the financial crisis in certain cases like RBS, for example, were a particular driver for change in the UK. Wirecard has recently driven a focus on the role of the supervisory board in Germany, and rapidly diversifying and advancing economies in the Middle East are driving more and more focus on good governance in taking leadership and attracting investment. So there is diversity, but also I would say a broad alignment to core principles of good governance. So rather than one region leading the way, as it were, the performance integrity of the board is always an obvious and measurable indicator of both performance and risk. So there are a couple of areas, though, that I would just say that some countries in the region are doing slightly differently, particularly compared to what is typically seen in the US. So in many countries internationally and in the EMEA region, board evaluations are prescribed using a 3-year cycle. So one full scope externally facilitated review at least once every 3 years, typically using interviews and other techniques, with at least a lighter touch self-review in the middle. In my view, prescribing those externally facilitated reviews at least every 3 years, it ensures take-up of a more rigorous and objective process, which really brings outside insight rather and perspective. Looser regimes where we tend to see just a review prescribed, if you like, every year or on an annual basis, can drive a view to go towards the lower cost and the simpler option, which means that some organizations are missing out on that objectivity. And then the other interesting area, and arguably controversial area of focus, is individual accountability at the board. So we've seen something driven by financial services regulation in the UK in the form of the senior managers regime, but being adopted in other countries already around the world, such as Ireland. It's on the agenda. In Australia, they're into their second form of the regime. The concept of individual directors having a clear accountability in line with their individual remits, for example, chair of the audit committee, is gaining some traction. And the real benefit is bringing those directors' responsibilities and the steps they take to fulfill them to the front of mind, to aid transparency for the benefit of stakeholders, for regulators, to staff, to shareholders, to customers. Rather than adding new responsibilities or anything like that, it's more about looking at things we can reasonably expect individuals in those positions to do. And after a hesitant start, I would say as well, many would argue it's proven quite compatible actually with the common kind of fundamental legal construct of collective accountability of the board. So it's one to watch. It's an interesting topic.
And James, in the last minute here, based on your experience working with boards, how do you see the evaluation process evolving over time, and any best practices that you can share?
Yeah, so I mean, optimistically, I would hope to see more value being driven by directors and secretaries themselves in this area. So board effectiveness isn't something to think about once a year or 3. It's a constant thing, and performance reviews are not standalone processes. They should be woven into the way boards are run. So every board should be striving for excellence, as far as I'm concerned. In the context, of course, of the company's size, nature, complexity, risk, and stakeholder profile. But I hope to see developments in 3 areas, I would say, within that theme. So one is more introspection and self-challenge when completing self-evaluation questionnaires. I think that means increased recognition that even basic reviews are about honestly evaluating collective performance and individual contribution. So we often see 9 out of 10s and 10 out of 10s on questionnaires and blank boxes when we have open questions, which really is human nature, but often driven by a view that evaluations are just about out of 10 scores. And really, they should be focused on a forward-looking continuous improvement. And then the second 2 areas, I would say, diagnostic checks on performance is a practice we've seen more through the pandemic. So in practice, that means quarterly or ad hoc mini evaluations focused on particular areas of performance, particular processes, particular decisions, which is a really interesting way of looking real time at how a board is operating and performing. And then finally, better embedding performance reviews into the board lifecycle. So I mentioned that this is a continuous improvement thing. Given evaluation shouldn't be standalone, I think the best boards actively work to clarify and demonstrate the links between key board and wider governance processes, covering evaluations, director appraisals, strategy setting and monitoring, board skills profile, succession planning, appointments and onboarding. All of those things, I often draw it as a cycle or a spider web. But I think that once boards understand those dependencies and the interconnectedness between them, then those elements are enriched as a result.
All right, James, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thanks, Jill.